Hello friends, welcome to Easy Learning Economics. This is Dr. Caval, PhD in Economics. Today, this video I have made for those candidates who are going to appear in the SPSC exam of lecturer in economics. So this video will be helpful for those people who are preparing for lecturer in economics. 100 economic and general concepts we are going to discuss. In this part, we will talk about 25 economic concepts. In the later parts, part 2, 3 and 4, we will discuss the rest of the concepts. So don't miss to learn and subscribe if you really want to learn with me. This is the solved sample paper which I shared with you. Here we discuss each and every MCQs with justifications, definition. We also illustrate graphs, pictures, reasons, equations, examples, and also I suggest my videos that would be helpful for the preparation of lecture in economics to clear your concepts more. This is the link through which you can evaluate yourself before to appear in the SPSC test of lecture in economics. And if you want to get the 100 MCQs with answer key, so you can click on this link, and the link is also given in description box. So this will prove yourself that where you stand with regards to your preparation, whether you are fit for SPSC test of lectureship or still you need to work more hard to clear your concept. So this will be helpful to evaluate yourself. So here we start the first question. When the price of Giffen goods falls, its consumption falls after a stage. This is because of option A, substitution effect, option B, income effect, option C, both A and B, option D, none of these. So which is the right answer? We have to choose the correct answer. What is the Giffen good? Giffen goods are those goods which violates the law of demand, that increase in price, decrease the demand fall. I have illustrated one diagram that will be helpful to clear your concept whether the option A, B, C or D is right. When the price is P1, the quantity demanded is OX3. So when the price decreases from OP1 to OP2, as a result, the purchasing power of consumer increases due to decrease in price. However, the income remains the same. As a result, that consumer moves towards a higher indifference curve at E2. However, the purchasing power of consumer has increased, but the consumer decreases the purchase of quantity of good X. So this is because of the income effect. Good X is treated as inferior now. Consumer moves towards normal goods or wants to purchase another good. So answer B is the right answer. So here I would like to suggest my video number 37, that is about the price effect, which tells you in detail that what is substitution effect and income effect. As we know that the price effect is combination of substitution effect and income effect. So this video will help you to clear your concept about substitution effect and income effect. Here the question number 2 is that who out of following economists was associated with the theory of unbalanced growth? And Rodin, option A, option B the Gunnar Myrdal, option C is the Lewis, option D is the Alberto Hirschman. So which option is right answer? That who propounded the theory of unbalanced growth? So we must know that the theory of unbalanced growth, that scholars such as Hirschman, Rostos, Fleming and Singer propounded the theory of unbalanced growth as a strategy of development to be used by the underdeveloped countries. It means this theory states that the investment is to be made in the major sectors of the economy due to the shortage of the funds. So according to this theory, the other sectors would automatically develop themselves through what is known as linkage effects. So the theory of unbalanced growth was propounded by Alberto Hirschman. So the D is the right answer. We want to know here that what is the difference between balanced and unbalanced growth. The theory of balanced growth was given by Renger Naxi, and the balanced growth theory tells about the investment is simultaneous. It means the investment is to be made in all sectors of the economy, and the balanced growth is a long-term strategy, and balanced growth is capital requirement is more in case of balanced growth. Whereas if we compare the balanced growth with unbalanced growth theory of Alberto Hirschman, we come to know that the investment is done in one sector at a time. So the investment is made in the selected sectors in case of the unbalanced growth, whereas the unbalanced growth theory is a short-term strategy, and the capital requirement is less in case of unbalanced growth. So this is the knowledge about the balanced and unbalanced growth, and now we are able to justify that which option is correct, as we know that the Hirschman propounded the theory of unbalanced growth. So the D is the right answer. The question number 3 is that marginal rate of substitution of x for y means. Option A, that the unit of x are sacrificed to get an additional unit of y. Option B, that the labor is sacrificed to get an additional unit of capital. Option C, that the capital is sacrificed to get an additional unit of labor. Option D, that unit of y are sacrificed to get an additional unit of x. So here these are the 4 options, and we have to pick the one correct answer. So as we know that the marginal rate of substitution of x for y, it means this deals with the consumer behavior, not with the producer equilibrium. This option B and option C is totally irrelevant in case of marginal rate of substitution of x for y. So this is irrelevant because this is telling about the marginal rate of technical substitution of x for y. Now the remaining options, we have the unit of x are sacrificed to get an additional unit of y, or unit of y are sacrificed to get an additional unit of x. We can justify our answer with this diagram, and we will be able to select the right answer. And in order to increase the 1 unit of commodity cigarette x, the consumer has to give up the 4 units of the commodity coffee, so that the marginal rate of substitution of cigarette for coffee states that the consumer is going to sacrifice the 4 unit of coffee, that is y commodity, and in order to get the 1 unit of commodity x, that is cigarette. It means that the marginal rate of substitution of x for y means that how much unit of y are sacrificed to get an additional unit of x. So D is the right answer, that unit of y are sacrificed to get an additional unit of x. So here I would like to suggest my one of the video number 33 you must watch with regards to learn about the marginal rate of substitution. In this video you will have a clear concept that how the marginal rate of substitution is different from marginal rate of technical substitution. Question number 4 is that the marginal cost curve for a product rises because of dissatisfaction from consumption. So option A is increasing satisfaction from consumption, option B is the decreasing satisfaction from consumption, option C is the constant satisfaction from consumption, option D both B and C. So which is the right answer? You must know. So we draw a diagram. With help of diagram it will be clear to justify our answer, that which is the right answer. Here is the example that will help you to understand. Suppose that the hours you study on economics, that more you will learn. So the marginal cost, the more you study, the marginal cost for learning economics will increase, whereas that on the other side the marginal benefit that you have a better knowledge will also increase. So that means the marginal cost curve for product rises because of the increasing satisfaction from consumption. A is the right answer. Question number 5. A day shift in demand function increases the equilibrium price and equilibrium quantity when the supply function has a positive slope. As we know that the shift in demand function means increase or decrease in demand. When the demand increases, the equilibrium price will definitely increase. However, the equilibrium quantity may increase or decrease will depend upon the elasticity of supply. The question 5 states in dash shift in demand function increases the equilibrium price and quantity when the supply function has positive slope. Option A is leftward, option B is the rightward, option C is upward, option D is downward. So which is the correct answer? Original equilibrium is this point. So when the supply has a positive slope, it means that the increase in price increase the supply. The rightward shift in demand function increases the equilibrium price. However, the equilibrium quantity may increase or decrease depend upon the elasticity of supply. So B is the right answer. Here I would like to suggest my video number 15 and 16 with regards to finding equilibrium price and quantity using linear demand and supply functions. So this video help you to find out the equilibrium quantity using the equations and linear demand function and supply functions. As you know that the linear means simple relationship between the two variables. Second video is market equilibrium and disequilibrium. So you must go through these videos you to have a better concept about this question. The question number 6 is that when a country imposes an important tariff, the effect on its offer curve is option A is nil, there would be no effect, or option B that the offer curve shifted away from the export commodity, that option C is that the shifted away from the import commodity, option D that neither B nor C. So when a country imposes an important tariff, it means tariff is a type of tax which is imposed by the government in order to restrict the import or restrict the exports. Imposing tariff shift offer curve inwards. As a result, the country is now willing to trade less for all terms of trade. The tariff imposing country's terms of trade improves. So the export price rises. As a result, the effects on the offer curve is that it shifted away from the export commodity. It means the B is the right answer. Question number 7. Theory of backwash effects relates to option A, only trade between an economically backward country and economically advanced country. Option B, the interregional disparities in the same country. Option C, both A and B, and option D, none of these. So which is the right answer? We have to select it. So what is the concept of spread effect and backwash effect? We must learn before to select the right answer. Is that the Professor Gunnar Myrdal builds this theory of circular causation. This theory of economic underdevelopment and development around the idea of regional inequalities. So these inequalities are found on national and international plan. So C is the right answer. Question number 8. If the value of price elasticity is between -1 and 0, the demand is option A, price elastic, option B, unity elastic, option C, price inelastic, option D, relative elastic. So which is the right answer? As we know that the price elasticity of demand means the responsiveness of change in quantity demanded with respect to change in price. Question is that when the elasticity value is between 0 and -1. So here we draw a graph that will help you to justify our answer. So as we know that the inelastic demand is that when the quantity demanded does not respond to change in price. 40% increase in price leads to decline 10% decrease in demand. So it means that it is inelastic demand, because the change in price leads to a smaller percentage change in demand is also inelastic demand, or that when a quantity demanded does not respond to change in price is also inelastic demand. So here we can conclude is the price inelastic. So C is the right answer. I would like to suggest my video number 21 and 22 that will help you to clear your concept about price elasticity of demand and how to calculate and interpret the elasticity of demand. There are two videos, part 1 and 2. Question number 9. If the total revenue changes in the direction opposite the price changes, the demand is option A is price elastic, option B is unitary elastic, option C is relative inelastic, option D is price inelastic. As we know that the total revenue is equal price into quantity, and total revenue and elasticity of demand are related. So if total revenue changes in the opposite direction from price, demand is elastic. When we say that the total revenue changes in the opposite direction, it means that when the price increases, quantity demanded decreases, and when the price decreases, the quantity demanded increases and revenue increases. And if total revenue changes in the same direction, it means that the total revenue increases but the quantity demanded does not change. So the total revenue increases with the change in price, but the quantity demanded does not change. So it is the inelastic demand in case of salt and medicine. If total revenue does not change when price changes, demand is unit elastic. Option A is the correct answer. So here I would like to suggest my one of the video number 20 that will help you to clear your concept about elasticity of demand and types in detail. Question number 10 is that primary capital market is one which option A advances long-term loans to an existing industry, option B purchase and sells second-hand shares and securities, option C does both A and B, option D deals in new shares and securities. So which is the correct answer? We have to decide. So we must know that what is the primary capital market. So this is the primary market in which that the investors are on the buying sides, whereas the corporates, companies and banks are on the other side. The market consists of the primary market and secondary market. The primary capital market deals in newly issued bonds and newly issued equities, whereas the secondary capital market deals in old bonds and old equities. So it is the clear now that which option is correct, that primary capital market is one which deals in new shares and securities. So option D is the right answer. Here, when marginal product and average product are equal, option A marginal product is rising, marginal product is falling, marginal product could either be rising or falling, marginal product is stationary. So which is the correct answer? We must learn through a diagram to justify our answer. Here is the diagram that will help you to select a right answer. So here you can see that the relationship between marginal productivity of labor and average productivity of labor. The marginal productivity of labor at this point is maximum, and the average product of labor at this point is maximum, where the marginal product and average product are equal, that average product is maximum but marginal product is falling down. So it means marginal product and average product are equal, that marginal product is falling. So this diagram has helped us in justifying our answer, that when marginal product and average product are equal, it means the marginal product is falling. So here answer B is the right answer. So here I would like to suggest my video number 38, that is about the law of variable proportion or laws of returns, in which you will learn about the three stages of law of variable proportion: increasing return, constant return and decreasing return. And also you will learn what is the relationship between total product, marginal product and average product. On the other side you will learn that the relationship between marginal product and average product, and also you will learn that when the marginal product increases, that the average product increases and marginal product lies above, average product decreases, that the marginal product decreases and marginal product lies below. So you will have a better understanding about this concept in detail. So now the question 12 is that by warranted rate of growth means, it means option A is the rate of growth warranted by the resources at the disposal of community, the rate of growth planned by the planning authority of a country, Option C, the rate of growth which would make planned investment equal to realized investments. Option D, none of these. So what is warranted rate of growth? Here is a diagram that will help you to justify our answer. So here you can see that the E is the point where the planned saving and investments are equal. This diagram will also tell you the warranted rate of growth is that 10%, 11% and 12%. So it means this is the warranted rate of growth when the planned saving and investments are equal at different points, when y0, y1, y2 and y3. These diagrams have helped us in selecting a right answer. So option C is the right answer. Number 13 is that when a country has a balance of payment deficit, it means option A, that the overall account is unbalanced. Option B, a persistent outflow of gold or continuous depletion of foreign exchange reserves or prolonged dependence on foreign trade. Option C, neither A nor B. Option D, the none of these. So which is the right answer? We must know about what is balance of payment. First of all, we must know about the balance of payment. As we know that the balance of payment is the record of economic transactions between the residents of one country and rest of the world. As balance of payment has major four accounts: the current account, capital account, financial account and net error and omission account. So which is the right answer? An increase in a country current account deficit might cause a change in external value of their currency. As a result, value of import exceeds over the value of exports. You must know about this thing before to select the right answer. What are the effects of current account deficit? When there is a current account deficit, it means the value of import is greater than exports. There is leakage from circular flow. Aggregate demand decreases. The effects of the current account deficit may cause depreciation in exchange rate, as we analyzed, and the foreigners will own more domestic assets, sign of uncompetitive exports and enables higher level of consumption. So these are the effects of the current account deficit. So which is the right answer? Now we are able to justify our answer that the answer B is the right answer, that when a country has a balance of payment deficit, it means there is a persistent outflow of gold or continuous depletion of foreign exchange reserves or prolonged dependence on foreign trade. Question number 14 states that a man buys flour etc for ₹20 and makes bread out of it and sells the bread thus made for ₹50. The value of transaction that will be included in income equation in respect of this transaction is option A is ₹20, option B is ₹50, option C is ₹70, option D is ₹30. So which is the right answer? As we know that the GDP includes final goods and services. As we know, the GDP means the money value of all finished goods and services produced in a country during period of 1 year, irrespective of the ownership of the resources. So final goods means the goods and services that are not purchased for the purpose of producing other goods, and services are for resale. Example, rice is the final good and pale or the husked rice is the intermediate product. So we count the rice directly. Including intermediate good and final good will result in double counting. In case of calculating the GDP, we include the final product in order to avoid the double counting. You can see that example of value added: if ingredients purchased for dairy milk is 30 paisa per bar, and ingredients made into a chocolate bar, and the chocolate bar sold to the customer for ₹1.20 per bar. So it means the final product price is 1.20. Right answer is B, because we conclude in the income equations that is the final product with product method is 50. So here the question number 15 is that A and B are two countries trading with each other. If A's elasticity of demand for B good is low and B's elasticity of demand for A good is high, the terms of trade are in favor of option A is A's favor, option B's favor, Option C is the both A and B's favor. Option D, none of these. So we must know about, first of all, the elasticity of demand. Elasticity of demand means the change in quantity demanded due to change in price. When B country decreases price, the A country does not increase its demand, whereas the B's elasticity of demand for A good is high. When A country decreases its price and B country increase its demand, so the terms of trade are in favor of which? So the terms of trade means that the ratio of export price and ratio of import price. So the ratio of export price are favorable in favor of A's favor. How? When the average price of export rises or average price of import remains unchanged, it means the terms of trade are favorable. When the average price of export remains unchanged or the average price of import falls, the terms of trade are favorable. When the terms of trade improves, it means the improved terms of trade might mean we are able to import cheaper food. A weak exchange rate increases the price of import, worsens the terms of trade, makes import of new technology more expensive. Important not to confuse the terms of trade with balance of trade. So the terms of trade means the ratio of export price to import price, and the balance of trade is the net balance of the merchandise trade balance and service trade balance. Is the right answer. Question number 16 is that the supply of certain good is perfectly inelastic. If there is a fall in demand, its effect will be a fall in quantity consumed, a fall in price, a rise in price, both A and B. When the supply of certain good is perfectly inelastic, it means the quantity supplied does not respond to change in price. If there is a fall in demand, so we make a graph. You can see here in this diagram that the supply is perfectly inelastic, supply is fixed and constant, cannot respond to change in demand. When the demand increases or decreases, that the supply remains constant here. So increase in demand, increase the price, decrease in demand, decrease the price. Demand decreases, supply is fixed, means that there is a fall in price. So B is the right answer. I would like to suggest my video number 26, that is about definition and types of elasticity of supply. In this video we have discussed in detail that what is elasticity of supply, what are the types of elasticity of supply, and how to calculate the elasticity of supply. An economy is said to be efficient when it has achieved option A, full employment, full consumption. When it has achieved, option B is that full employment, full production. Option C, that full consumption, full production. Option D, full capital, full production. So which is the right answer? With the help of graph we can justify our answer. This is the graph which shows that the China total energy production and consumption since 1978. So China is producing much energy and as well as consuming the more energy. So it means that China is efficient economy. It means when it produces more and consumes more. So this diagram has helped to justify our answer, that answer C is the right answer, because an economy is said to be efficient when it is there, it has achieved the full consumption and full production. Question number 18, if the exchange rate of rupee increases against dollar, it is option A, appreciation of rupee, option B, appreciation of dollar, option C, both A and B, D, the depreciation of rupee. So we must have a clear concept in justifying our answer. So first of all we should know that what is the exchange rate. The exchange rate is the rate at which the country's one currency is exchanged for another. So when the exchange rate of rupee increases, it means few rupees are required to purchase the foreign currency. When the exchange rate of rupee decreases, it means the more rupees are required to purchase the foreign currency. Appreciation of rupee means that less rupees are required to purchase the foreign currency. Appreciation of dollar means that when the few dollars are required to purchase the euro. And the depreciation of rupee means that the more rupees are required to purchase the foreign currency unit. It means that if exchange rate of rupee increases against dollar, it means this is the appreciation of rupee. So this diagram will help you to understand more in detail that increase in demand for dollar leads to depreciation of rupee and appreciation of dollar. So answer A is the right answer. Number 19, that when the price of Y changes and the quantity demanded of X changes in the same direction with the price of X held constant, X and Y are option A, substitute goods, option B, Giffen goods, option C is the complement goods, option D is the inferior goods. So we must know that what is substitute goods, Giffen goods, complement goods, inferior goods before to select any option, because when the X and Y are changes in the same direction, it means that the cross elasticity of demand is positive. When cross elasticity of demand means that change in quantity demanded of X due to change in price of Y, it means the goods are substitute. Giffen goods means it means that the which violates the law of demand, and complement goods mean the cross elasticity is negative, and inferior goods that income elasticity is negative. So here these are the substitute goods like car and cycle, like Colgate and Dr. Pest, like Pepsi and Coke, like burger and pizza, tea and coffee. This is the tea and coffee, and each price of tea and coffee is 50 rupees, just suppose. When the price of coffee increases from 50 to 60 rupees, the demand for tea will automatically increases. So they move in the same direction. So cross elasticity is positive. So the goods are substitute. Answer A is the right answer. I am suggesting my video number 6 and 25, that is about the types of good with daily life examples, and video number 25 is about cross elasticity of demand and its calculation. The number 20 is price ceiling is fixed. Option A, at equilibrium price, option B, above equilibrium price, option C, below equilibrium price, option D, both A and B. So price ceiling is the maximum legal price above which the seller can't sell anything, and the price ceiling is set below the equilibrium price in order to encourage the demand and discourage the supply, in order to give protections to unaffordable persons, make the availability of their goods to those people who can't afford it. Where the equilibrium market clearing price is at this point, but the price ceiling price is below the equilibrium price, that is at this point. So this is the legal price ceiling set below the market price. So why the price ceiling is set below the equilibrium price? Because to encourage the demand and discourage the supply. So it means the price ceiling is fixed and set below the equilibrium price, whereas that the price floor is set above the equilibrium price in order to discourage the demand and encourage the supply. So here the right option is that C is the right answer. So because that the price ceiling is set below the equilibrium price. Now the question number 21 states that for the Cobb-Douglas production function, option A, the law of diminishing returns to scale hold, option B, the law of constant returns to scale hold, option C, can't say without more data, option D, the law of increasing returns to scale holds. So which is the right answer? We must know about the Cobb-Douglas production function. Cobb-Douglas production function is an exponential form of production function in which we derive the partial derivation of labor and capital in order to find the marginal productivity of labor and capital. The Cobb-Douglas production function has a constant returns to scale and diminishing marginal productivity. The production function, Cobb-Douglas production function, is AK alpha 1 minus alpha. So the alpha and 1 minus alpha must equals to 1 if it means this is the constant returns to scale. So the marginal productivity of labor, it means that the change in output with respect to 1 unit change in labor, whereas that the marginal productivity of capital means that the change in output with 1 unit increase or 1 unit change in capital. So the Y means output, A means technological efficiency, and K means capital, alpha, L 1 minus alpha. Alpha and 1 minus alpha, these are the elasticity of labor and capital. Which is the right answer? Now we have a clear concept that for the Cobb-Douglas production function, the law of constant returns to scale hold. It means that doubling the input, we get the output become doubled. So answer B is the right answer. For optimal Pareto allocation of resources between two goods. Option A, the ratio between explicit costs should equal the common ratio among consumers between their marginal utilities. Option B, the ratio between marginal social costs should equal the common ratio among the consumers between their marginal utilities. Option C, the ratio between their prices should equal the ratio between their cost. Option D, none of these. Pareto improvements means that output of both products can increase as we move from within the PPF, means production possibility frontier, to points on the PPF boundary. The marginal cost curve, MC shows the marginal cost curve and MB1 shows the marginal benefit curve for person 1, and MB2 shows the marginal benefit curve for person 2. MB1 plus MB2 shows the marginal benefit curve for society, person 1 and 2, and IP1 individual price for person 1 and IP2 shows the individual price for person 2. It means the B is the right answer. For optimal allocation of resources between two goods, the ratio between marginal social cost should equal the common ratio among the consumers between their marginal utilities. Question number 23 is that underwriting of shares and debentures are done by money market, option B, discount market, option C, both A and B, option D, none of these. Underwriters are those persons who provide guarantee for subscription of shares and debentures. Underwriters may be a person, group of persons, firms, or company. Underwriting of shares and debentures is an agreement between the company and a person on group of person to provide guarantee that in case share or debentures are not fully subscribed by the public, they will purchase the balance of shares and debenture. This is all about the underwriting of shares. Now we must learn that what is discount market before to select the right answer. So discount market is the part of money market consisting of banks, discount houses and brokers on which bills are discounted. A trading market in which notes, bills and other negotiable instruments are discounted. Still, we want to learn another thing before to select a right answer, that is what is the meaning of money markets. Money market refers to the market where money and highly liquid marketable securities are bought and sold, having maturity period of 1 or less than 1 year. It is not a place like a stock market but an activity conducted by the telephone. The money market constitutes a very important segment. The highly liquid marketable securities are used called as money market instruments like treasury bills, government securities, commercial paper, certificate of deposits, call money and repurchase agreement. These are the documents used in money market. So according to Geoffrey, money market is the collective name given to the various firms and institutions that deals in the various grades of the near money. So our concept is clear now. So it means the underwriting of shares and debentures are done by the discount market. So B is the right answer. Question number 24. A central bank accommodates commercial banks with loans and rediscounting facilities. It does so in its capacity as option A. Central bank is custodian of cash reserves of the commercial banks. Option B. Central bank is a bankers to the government. Option C. That the central bank is a bank of note issue. So option D. Central bank is a lender of lost reserves. So what are the functions of central bank? The central bank is authority to issue notes and coins, ensure stability of banking system. Central bank set the interest rate. Central bank is the lender of last resort to the government and also the lender of last resorts to the commercial bank. Why we say that the central bank is a lender of last resort? Because a central bank accommodates the commercial banks with loans and rediscounting facilities. That's why now we have a clear concept and justification of our answer that the D is the right answer. The question number 25. In calculating the infant mortality rate, we consider the number of children who die, option A, before they attain the age of 1 year, option B, within a month of their birth, option C, before they attain the age of 5 years, option D, both B and C. So infant mortality, when we calculate the infant mortality or infant death rate, we consider number of children who die before they attain the age of 1 year. So answer A is the right answer. I hope that you have enjoyed these 25 different economic concepts in this part, and the rest of the questions we will discuss in part 2, 3 and 4. If this video is helpful in clearing your concept, so you must subscribe my channel in order to learn more about economics in detail. How my video is helpful for you, please comment, so it will encourage me. Thank you very much for watching. If you have any query, you may ask in comment box.